Hi, I'm Richard Murphy, and this is the 20th in the video series on the importance of tax transparency that I am hosting, and which is being made jointly by the University of Sheffield, where I work as a professor of accounting practice, the Global Initiative for Fiscal Transparency, and the International Budget Partnership. In this video, we're exploring taxes on wealth. The taxation of wealth is difficult in many jurisdictions in the world. It is maybe especially so in lower income countries. Taxes related to wealth split into two groups: taxes on wealth and taxes on income and transactions derived from wealth. Wealth taxes, such as a fixed percentage annual tax charge on a person's wealth above an agreed limit, are incredibly hard to impose and collect because, firstly, that wealth has to be located. Secondly, then it has to be identified as belonging to a specific person. Thirdly, it has to be valued, and that can be hard and open to dispute. Fourthly, the tax, when those processes are complete, has to be collected, which can be difficult if the wealth is located outside the country. And lastly, that process has to be repeated all over again for the next year. Very few countries in the world think that this is worth the effort involved, especially as potential tax revenues are often quite modest for the amount of disruption created. If this is the case in the jurisdiction, that should be noted in its tax strategy. Taxes on income and transactions derived from wealth include higher levels of income tax, additional income taxes on income derived from wealth as compared to work, taxes on capital gains, taxes on gifts and on death, taxes on capital transactions, including stamp duties on land contracts or other financial transaction taxes, such as those on share dealing, license fees for activities that only the wealthy are likely to partake in or own, such as charges for the use of private aircraft, yachts, high-value cars, and other such items. In most jurisdictions that have such taxes, the amount of additional revenue from anything but higher rates of income tax tends to be small. It is important to stress that if these taxes exist, it is very largely to fulfill a social purpose, which is to reduce the income or wealth inequality within a jurisdiction. However, aside from higher rates of income tax, lower income countries often do not rely heavily on such taxes, precisely because they rarely achieve the desired noted outcome to any significant extent. That said, this does not mean that a tax authority should ignore these taxes, most especially when it comes to establishing its tax strategy. It is vital that it explains what its approach to wealth taxes is, even if that means it will not tax them. The reason for this needs to be understood as much as any charge that might be imposed. If a charge is to be imposed on any income or other transactions that might be specifically related to wealth, then the reasons need to be explained. The chosen rates need to be explained, and the sums on which they might be charged need to be justified. Any exemptions, allowances and reliefs need to be explained. The obligations placed on the taxpayer to declare liabilities owing must be clearly set out, and the expected benefits arising from the charge must be explained as part of any budget process in ways previously explained in this series. In summary, even if many jurisdictions do not impose either wealth taxes or additional taxes on income and transactions arising from wealth, it is important that these transactions be taken into consideration when setting a tax strategy. And if they are charged, careful justification is required as a part of any tax transparency program.